So hello everyone, we are going to revise fundamentals, partnership fundamental chapter, and it is going to be bullet revision. The prerequisite of this video is that you have to revise the entire chapter on your own first and then sit for revising things along with me. What will you need to revise this? If you have my notes, very good. You should have the hard copy ideally. If you do not have the hard copy, do not see the notes on the device on which you are viewing the video. You should keep, if you're seeing on the laptop, you keep your mobile aside and keep the files open. If you are not my student, then you keep your book open or whatever notes you have made, if your teachers have given any notes. Otherwise, simply the book, whichever book you're following, you open that book and keep revising from there. And the best utilization of this video is that you should have done this chapter on your own once, then you will get the maximum benefit. So let us start. I will not take much time. Fundamental is a big chapter, but there are a lot of concepts which are very, very simple, but everything has become important now because you have multiple choice questions. So whenever there is multiple choice question test, each and every aspects become important and you have to have the clarity of every aspect, okay, every concept. So first we'll start with this provision of Indian Partnership Act 1932. When we start fundamental chapter, it starts from there. So this is purely theoretical part, importance of Indian Partnership Act 1932. What you can do, you can just run through it once. Okay, you don't have to mug it up. Some important sections, if it is written over there, what is the definition of Partnership Act, under which section and all. I don't think so it will go in that much of detail, but yeah, you have to be prepared for everything which can come in the exam. So in book, there are sections given. In this notes, sections are not given. So you just go through the sections. If you do this reading 5-6 times, you will be able to answer because you will have option and you will be able to answer the question. Now, what are the provisions of Indian Partnership Act in absence of any partnership deed? See what happens. Many a times, the questions which will come in front of us, it will mention that the partners are, doing the business, but they do not have any partnership deed. And Partnership Act 1932 even does not make it necessary to make the partnership deed compulsorily. It says that if they make it, it is good. There are certain advantages which you must have studied in class 11th in theoretical subjects. Even if they do not make, there is no compulsion. It's still the partnership will be valid. But if they do not have partnership deed, then what kind of provision of Partnership Act 1932 will be applicable? This we'll see, which will be applicable in numerical questions also, and a lot of cases are there on which it will be applicable. Okay, so first of all, what will be the profit sharing ratio among the partners if they have not made any partnership deal? So in that case, always the partners' profit sharing ratio is going to be equal. If there are two partners, they will share profit equally, means 1.5 and 1.5. If there are 3 partners, it will be 1/3, 1/3, 1/3. If there are 4 partners, 1/4, like that. Okay. Here, no partner can say that that particular partner has more of capital. That is why he or she should be getting more share of profit. No, nothing like that will be allowed. If there is no partnership rule, the very simple rule that all the partners are going to equally share the profits and losses. Second point is interest on capital. So no interest on capital will be allowed if there is no partnership deal. If partners want to take some interest on capital because of the opportunity cost, then they will have to write this down in the partnership deed, that what will be the interest on capital given to each partner, and whether it is charge against capital, charge against profit or no. That will be doing in the coming concepts, that what is interest on capital. How do we deal with this, whether it is charge against profit, whether it is not charge against profit. There are different treatments for that. Interest on drawings, since there is no partnership deed, so no interest on capital is given. Similarly, no interest on drawings is charged. So both these things are no. Okay. Fourth one, interest on advances, loans by partner. See, partner is investing capital in the capacity of a partner. But sometimes it happens so that the business is in need of money and a partner is lending money to the business. Listen to me carefully what I'm saying. lending money to the business. The partner is not investing money to the business. Lending money means he intends to give loan to the business, which he'll take back. And obviously, on this loan, the partner should be given interest. Why? Because if we had taken this loan from somewhere else, we would have paid some interest to that institution, whether it was bank or some other institution. So interest will be given. Here we cannot say, since partnership deed is not there, no interest will be provided to the partner. Of course, interest will be provided to the partner. And what will be the rate of interest? This is going to be 6% per annum. Now, there is this per annum word's importance. 6% per annum means, suppose a partner has given loan. Let's say your year is starting from 1st of April and it is ending on 31st of March. And the partner has given loan or advance to the firm on 1st of October. The partner is going to get interest on loan for 6 months. Why? Because this is yearly interest rate. It is not a flat interest rate. So you have to be careful for this, and you are going to charge interest for 6 months only. So when the questions come, you have to take care of this part. And this interest is a charge against profit. Charge against profit means you make profit and loss account and then profit and loss appropriation account. So this interest on loan given by the partner is going to come under profit and loss account. Means even if there is a loss, this interest on loan given by the partner will be given to the partner. Why? Because he hasn't invested this money into the business. He has given us the loan. That is why it is charge against profit. This particular terminology you should be using again and again in your mind. Obviously, you're not writing theoretical answers, but because if it comes in multiple choice questions, so this particular term will be used over there. So you have to be thorough with this, and you have to read it again and again so that it sits in your mind and you are able to answer. Then the last part, 5th point, salary, remuneration, commission to a partner. So there will be no salary, no remuneration will be provided to any partner, whether it is an active partner, it is an inactive partner, which you say dormant or sleeping partner, nothing will be provided. So these 5 points you have to bear in mind. First of all, the profit sharing ratio is going to be equal. Next is no interest on capital. Third is no interest on drawings will be charged. Fourth is interest on loan will be provided to the partner at the rate of 6% per annum, and no salary, remuneration or commission. Means nothing additional will be given apart from the profit to a partner. Okay. I hope this is clear to all of you. Now, there are some illustrations given. Now, you have reached to such stage where I don't think you need these illustrations to do. But yes, this is important. For this particular revision, it is not important to do this illustration over here because you have already done your chapter once. Some people must have revised it also. So, there is no need to do it in this revision. But yes, this kind of questions may be asked in your multiple choice questions. So, you have to be thorough with this. Okay, so you will do this. You can do it from your only notes in your T.S. Giraval sir's book. Also, there are various questions given in illustrations, and there are questions given before the practical questions start. There are some initial questions given on this. Whatever book you are following, T.S. Giraval sir's book or D.K. Goel sir's book, you can follow from there. There are questions like that. So do not forget to practice those questions. All these questions I'm skipping, and I'm moving to the next topic, which is interest on partner's loan to the firm. This is the same loan about which we spoke earlier. I spoke earlier about 6% interest rate. So whenever a partner is providing loan to the firm, what is the treatment? Here, closing and opening entries are very, very important entries because the question can be asked on the entries itself. So what it is saying, the loan advanced by a partner to the firm is credited to his loan account. It cannot go to the capital account. First of all, remember this. Why? Because when he is investing capital, he is investing capital in the capacity of partner. At that time, he is not a lender to the firm. But when the same partner is lending money to the firm, he becomes the lender, a creditor to the firm. That is why his loan account will appear separately in the balance sheet, and his loan account will be made separately. If you see in the balance sheet, it will reflect like this. Suppose there are capital accounts. So there will be capital account of the partners, A, B, C. Suppose there are 3 partners. And then if C has given the loan, so C's loan account will reflect separately. The reason is that when this particular partner is giving loan to the firm, at that time, he is not giving loan to the firm in the capacity of partner. He is giving loan as a creditor to the firm. So like creditors are separately reflected, or if you have a bank loan, bank overdraft, that is separately reflected. Similar way, This C's loan also is going to be reflected separately in the balance sheet. Okay, and C's loan account, I'm talking about the ledger. If you have to make ledger, C's loan account will be made separately. It will not be merged along with his capital account. So as for the provision of partnership deed, loan by a partner is repayable before capital is paid at the time of dissolution. This is also important because multiple choice question, there can be a theoretical question based on this. So what is the order of preference? Like see, when you study issue of share chapter, at that time you all have studied what is preference share capital. So you know there are two types of preferences given, something like that. Like before equity shareholder, preference shareholder will be paid here. Before the repayment of the capital invested by the partner, payment of the loan will be done. So if it happens so that the firm is dissolving, the business of firm is stopping, at that time, who will be paid first? Whether the partner's capital account, whatever balances are there, that we are going to pay, or outsiders liability? Definitely outsiders liability. And outsiders liability do include a partner's loan also. So suppose, let me take an example and explain it to you. For example, you have 50,000 rupees left after paying to all the liability to the outsider, and now you have A, B, C's capital accounts. Let's say A has a 10,000 closing balance, B has 20,000 capital balance, and C has, let's say, 15,000 capital balance, and C's loan account is also there, which has 20,000 balance. So 10, 20 and 15. How much is this? This is going to be 45. This is 45,020. But we have only 50,000 available. So in this case, or in the other case also, when there is sufficient money to pay these as well and this as well, first payment will be done to the loan account, and then afterward, whatever is left from there, it will be made. Such kind of questions are not there in the book. Okay, that you will be studying on the higher levels. But let's say, let me make this amount 65,000 rupees. Okay, so this is 65,000 rupees. First, out of this 60,000 rupees, 20,000 will be paid towards to C's loan. After that, A's, B's and C's capital account will be settled, means the amount will be returned to them. Whatever they had invested, that will be returned by firm to them. Okay. In absence of any agreement, partners are entitled to the interest at the rate of 6% on the loans, which we have studied earlier also in that table. Now, what is the rate of interest and all? This is same. What is nature of interest? Nature of interest is a charge against profit. See, again, this particular wording is used. So, highlight it wherever it is written. Mark it very, very important, because this charge against interest means it is going to profit and loss account. It will never go to profit and loss appropriation account. This is an important point which you have to remember when you are doing the numerical question and for the theoretical questions as well. It is important point. Now, what is interest accounting treatment? What will be the journal entry for interest paid? See, interest can be paid or interest can be due. Means question can give you a hint that interest is due but not yet paid. The first entry in both the cases, whether interest is paid or interest is due, is going to be same. That is interest on partner's loan account debit to cash. Sorry, first entry will be different. Second entry is going to be same. So it will be to cash or bank in whichever way it is paid. So here the interest is being paid. If interest is due, that due entry is means credit side is going to come partner's loan account. So interest on partner's loan account debit to partner's loan account. This account will be there. Now you have opened this account. Interest on loan, partner's loan. It has to be closed. Partner's loan account will not be closed until we have made the payment to the partner. Whatever loan he had given to the firm, until that is repaid, you are not going to close this account. This will remain open. But what about interest on partner's loan? All the expense account and all the incomes account, from class 11, need to be closed. And where do we close them? We close them in profit and loss account, and some accounts are even closed in profit and loss appropriation account. This is a charge against interest. That is why it is going to be closed in profit and loss account. So see, this is called closing entry. If somebody asks you what is the opening entry and closing entry, so this is the opening entry and this is the closing entry. In some books, directly this entry is passed, but I will always say, and when I taught you at that time, I had taught you both the entries. So you must know both the entries. Now it has become all the more important, because in multiple choice question, they may ask you what is the opening entry and what is the closing entry. So in that case, you should know both the entries. So profit and loss account will be debited to interest on partner's loan, and here profit and same entry. So profit and loss account will be debited because this is an expense for the firm. So for all the expenses, profit and loss account is also a nominal account. Profit and loss account will be debited. So opening and closing entries both should be very clear to you, and rate of interest should be there in your mind. And what is the most important word here? Charge against profit. Okay, I hope this is clear to you. Now, next type of loan. What is it? This is interest on loan by the firm to the partner. This particular one, which I explained to you right now, was the loan by the partner to the firm. Means partner is the lender. Whenever firm is in need of money, firm has taken loan from the partner, and this loan is a liability of the firm. It comes on the liability side of the balance sheet under the head partner's loan account, and interest on it is a expense for the firm. That is why it is a charge against profit, and it comes under profit and loss account. But sometimes this also happens that partners, apart from their drawings, they do take loan from the firm. Okay, apart from the drawing, because drawing treatment, you all know that drawing treatment is separate, and there is interest charge on drawing if there is partnership deed. If there is no partnership deed, there is no interest charge on the drawings made by the partner. But what about the interest which is what about the loan which is taken by the partner from the firm? Okay, so from firm's point of view, if I want to term it, it will be termed like this: loan by the firm to a partner, and this is an asset. Now the partner has become debtor to the firm. Partner is liable to pay to the firm. So on the asset side of the balance sheet, it will be reflected. So if you see in the balance sheet, it will come here, loan to partner. Okay, if it is C's loan, it will be loan to C. And if C has given loan to the firm, this will be loan from C. So to and from is important over here, and the placing also. Obviously, if it is on the liability side, means firm has taken loan from the partner. If it is on the asset side, it means the partner has taken loan from the firm. Means firm has granted loan to the partner. So in this case also, there will be interest charge. Now, some people may think that if there is no partnership, are we going to charge 6% partnership deed? Are we going to charge 6% interest on the loan which is provided by the firm to the partner? Answer is no. Partnership Act 1932 does not say anything about the loan given by the firm to the partner. It talks only about the loan granted by the partner to the firm, and talks about the interest rate, which is 6% per annum. On this particular matter, Partnership Act 1932 is silent. If the act is silent and partnership deed is not there, it means no interest is to be charged. If there is no partnership deed, we cannot apply the provision of act. But if there is clearly mentioned in the question that this is the rate of interest at which firm has given loan to the partner, then we will be charging interest from the partner. And ideally, we should be charging, but we'll have to depend entirely on the information provided by question. We cannot do anything on our own. What will be the journal entry? Accounting treatment, again, opening and closing entries will be asked to you, and you must know the opening entry. So to charge interest on loan from the partner's capital or current account. Now, very important point, do remember, loan to the partner, no separate account is open. Loan from the partner, a separate account is open, but whenever a partner has taken a loan from the firm, there is no separate account open for that. Its interest and its closing is done in the partner's capital or current account. Now, why, ma'am, it is capital or current account both written over here? It all depends on what kind of method of capital account is being followed by the firm. If there is fixed capital method followed, then there will be current account. If there is fluctuating capital, then will be capital account. So either of that will be present, both will not be there. To interest on partner's loan, this is opening entry, first entry. Then the closing entry, where are we going to close? Again, it will be closed in profit and loss account. So interest on partner's loan, which was credited over here, will be debited, and profit and loss account will be credited. Why profit and loss account will be credited? Because this is an income for the firm. Then we like interest on drawing. Interest on drawing does not come in profit and loss account. It comes in profit and loss appropriation account. This is a different account. This is loan given to the partner. So for this interest, if we are charging interest from the partner on the loan, it comes in profit and loss account. The closing will be in profit and loss account, not in profit and loss appropriation account. And here also you have to remember this is partner's capital or current account. So at two places the entry will be passed. One, in profit and loss account, it will be credited to profit and loss account, which will increase the profit because it is an income for the firm. And second, the entry will be made in the partner's capital or current account. No separate loan account will be open. Account will be open. Okay, like, but for that, for interest by for loan from the partner, there will be separate account open. I hope this is clear. I'll take the doubts in a while. Now let us go further. Rent paid to partner. Rent paid to partner. Why are we going to pay rent to the partner? See, partnership may be run from the premises of the partner, of one of the partners. So if we are running our business from one of the partner's place, then in that case, we need to pay interest, we need to pay rent to that partner. Okay, that whatever rent is in for the same premises charged in the nearby locality or the same building's rent, whatever is rent is there, we have to pay this rent to the partner. And this is again charge against profit, like interest on the loan from the partner is a charge against profit. It is debited to profit and loss account. In the same way, rent paid to the partner for running the business from his premises, we have to pay that rent, and we have to write it in profit and loss account. It will not go to profit and loss appropriation account. It is a charge against profit. Whenever I say charge against profit, it means even if there is insufficient profit to pay that rent, you have to pay. Even if there is loss, you have to pay rent. You cannot say to your landlord that we have not earned income this month, so there is no profit in this particular year, do not take rent from us. Nobody is going to listen to you. You have to pay rent. Once you have made the commitment that you are occupying this place, you have to pay the rent, whether you are making money from that place or not making money from that place. It means it is a charge against profit, so it may increase your losses if you are in the loss. What will be the opening and closing entries? Opening and closing entries are going to be, first, rent to cash or bank if rent is being paid. If rent is not being paid, then again it will go to partner's capital account. So the crux is that only for partner's loan, the loan which is being given by the partner to the firm, a separate account has to be opened. Otherwise, loan to the partner, no separate account has to be opened. Rent, no separate account has to be opened. All these two things will be inculcated in partner's capital or current account itself. So if we have paid, cash or bank account will be credited. If we haven't paid, his current or capital account will be credited. Closing entry is going to be same in both the places, which will be profit and loss account debit to rent account. Why profit and loss account is debited? Because it is an expense for the firm. That is why profit and loss account is going to be debited. Okay, after this, we'll be starting the next topic, which is profit and loss appropriation account. Now, what is profit and loss appropriation account? Very important. Profit and loss appropriation account, making of profit and loss appropriation account, and what is the difference between profit and loss account and profit and loss appropriation account, and what entries are passed, what is debited and credited in profit and loss appropriation account. This all you should have a clear idea. Okay, there are many questions given in the book which you have done along with me also. So keep revising those questions. Now here I will give you a tip. Do not focus on the format of the account, but you just need to know how to pass the entries for this profit and loss appropriation. Practice the journal entries as well and format of making. You don't have to focus too much on the format, narration of the journal entries and all, but you should have a clear idea. So here you don't have to think, now the questions are going to come in multiple choice question format, so we don't have to write. No, before seeing the option, you must know your answer. So you have to do same practice which you were doing earlier. Only difference is that earlier you were focusing on the format also, now you don't have to focus on the format. So now understand what is profit and loss appropriation account. I always say profit and loss appropriation account is owner's account. Owner's account means who is the owner of business. Owner of business is partner. All the partners are owner of business. So whatever they are going to get from the profit, that is their account. And this is all treated in profit and loss appropriation account. So profit and loss appropriation account is made. What is the sequence of making profit and loss appropriation account? First, profit and loss account will be made. Whatever profit is generated from there, it is transferred to profit and loss appropriation account. Then that profit is distributed among the partner. Apart from profit, there are other things also provided to the partners, like If there is a partnership deed and it says that a particular partner should be provided salary or commission or any other remuneration will be given over here, owner's account. So owner's remuneration should be coming in profit and loss appropriation account. If any interest on capital is given, obviously that will also come in profit and loss appropriation account. Just remember in your mind, owner's account, all that which is given to the owner will go to P&L appropriation account. If there is interest on drawing, it is going to be written over here. Any expense related to the owner, not that interest which you are charging on the loan, but the interest on the drawing will also come over here. So interest on capital, salary or commission, interest on drawings transferred to general reserve. Also, if some part of profit you are transferring to some reserve for the general reserve, not giving to the partner, this will also be written over here. And finally, distribution of profit. And it happens so that initially there was profit, and after all this distribution, there is loss. Okay, the negative balance is coming, means your debit side balance is coming more than credit side, then the loss will also be distributed from here itself. But initially only if there is loss, there will be no profit and loss appropriation account made. There are very good questions given in T.S. Grewal's book for that. Okay, now let us see what are the opening and closing entries related to profit and loss account, which is called adjusting entries. So first, for interest on drawing, what entry is passed for interest on drawing? Opening and closing entry. Opening is also called adjusting entry. First is partner's capital or current account, whatever method they are following, individually, each partner will be debited to interest on drawing. And how the closing will take place? Interest on drawing will be credited. It will be debited, and profit and loss appropriation account will be credited. What is the nature of profit and loss appropriation? This is also a nominal account only. Here, whatever is the income of firm, it will be coming on the credit side. That is why it is credited over here. Okay, the next one is for interest on capital. Now, interest on capital is an expense for the firm. Firm is paying interest to the partner. So obviously it should come on the debit side, but opening entry, first you have to see what is opening entry. Interest on capital to partners, capital or current, whatever method is being followed, accordingly capital or current account will reflect over here. Now this interest on capital is an expense. That is why profit and loss appropriation account should be debited. So P&L account will be debited and interest on capital will be credited. Then the next one is regarding partner's salaries or commission. If any salary or commission is provided to the partner, so first partner's salary, first means adjusting entry will be partner's salary, commission, remuneration, whatever name it is called, will be debited to concerned partners, capital or current account. Okay. Then the closing entry. Closing entry, again, this is an expense. So for expense, P&L appropriation account is going to be debited and partner's salary or commission will be credited. Now here it is very important that do remember, do not write partner's capital account, because when you make the ledger, you write it in profit and loss appropriation account, and from profit and loss appropriation, you bring to the partner's capital account. So sometimes students, when they, in the back of their mind, they think about the profit and loss appropriation account, they by mistake write P&L appropriation, partner's capital account over here, partner's capital account. You don't have to write partner's capital account over here for the closing entry. You have to close this account which was opened over here. So it has to come over here. What is profit? Partner's salary or remuneration or commission, whatever name it is. Okay, so here you have to be careful. If you are writing in your notes, or if you do not have notes in front of you, just write down somewhere in your notebook that this is a mistake prone area. Okay, and when questions come in the form of multiple choice question, the chances of making mistakes are more. But that is only initially. Once you are through with this, you have practiced multiple times, then you will not make mistake. Yeah, initially it is going to be tough for you all, because from all these years you were in the habit of writing descriptive type of answers, and now for the first time you are going to write multiple choice question paper and full question paper in a multiple choice format. Then it will take some time to get hang of it. But once you are done with this, I'm very sure you will be able to solve those questions properly. Now, let us go for the last two. For transferring the reserve, no opening and closing, only one entry is to be passed. That is profit and loss appropriation account debit to reserve account. Whatever reserve it is, reserve fund or general reserve, you will transfer it over there. Then last, if there is profit, so profit is to be transferred by profit and loss appropriation will be debited and to partner's capital or current account, whatever method is being followed. So individual partner's name will have to write A, B, C, D, which we'll see below in this ledger format of profit and loss appropriation account. So whatever entries we have made over here, all the closing entries you will find here. First is profit and loss appropriation account. The balance of P&L account will be transferred. So whatever net profit from P&L account is there, it is transferred over here. It comes on the credit side. If there is any interest on drawings charged from the partner, it will come. Since it is income in the nature, it will come on the credit side. Ideally, only these two things will come over here. There can be one more thing when a partner has given guarantee to the firm, that we'll see later. Interest on capital is an expense, and that is why it is going to come over here. Partner salaries, whatever salaries, remuneration, commission you are providing, all this is going to come in the debit side of P&L account. If you're transferring anything to reserve or general reserve or reserve fund, all that is going to come over here. And if there is profit, it is going to come over here. If there is loss, then the loss will be transferred from here. Okay, I hope this all is clear till here. Now, I hope this profit and loss appropriation account is clear to all of you, and you have to revise it multiple times. Until you don't revise it, the clarity is not going to come. That is why I suggest that you have to revise it multiple times, not just once. If you revise only once, it is not going to help you. Now, I'm sharing the next one with you. The next one is the difference between profit and loss account and profit and loss appropriation account. Though this is purely theoretical, earlier I used to tell students that you have to do the self-study for this. I never taught it, but because now there are multiple choice questions, that is why I will just make you run through it once, okay, very fast. So stage of preparation, first, after trading account, profit and loss account is made, and then after that, profit and loss appropriation account is made. Then if we talk about the objective, it is prepared to determine the net profit, and profit and loss appropriation account is prepared to determine what is the share of profit which each partner is going to get. If I talk about nature of items, what items are debited, all the expenses which are charged against profit, like rent, salaries to the staff, like interest on partners, loan account, etc., will be debited to profit and loss account. And the incomes, okay, which are not interest on drawings, etc., other incomes like interest received, commission receipts, etc., will be credited to profit and loss account. Whereas profit and loss appropriation account, whatever we are giving to the partner in the form of interest on capital, in the form of salary, in the form of remuneration, etc., that all is going to come in the debit side of profit and loss appropriation account. On the credit side, what is coming? On the credit side, whatever is transferred from profit and loss account means net profit will come, interest on drawings will come. Okay, so only these things are going to come in the credit side of profit and loss appropriation account. Now, if we talk about what is partnership deed or agreement, is there any impact of on the preparation of profit and loss account? So the partnership deed of this account is not guided. The partnership deed is not guiding how profit and loss account has to be made. It is a general rule how for every business, whether it is a partnership business or a sole proprietorship business, how generally profit and loss account is made, that is being followed. But for profit and loss appropriation account, yes, we do have to see what is the deed saying or what is Partnership Act 1932 saying. If partnership deed is not there, then how are you going to distribute profits obviously equally? If partnership deed is not there, are you going to give interest on capital? Answer is no. Are you going to charge interest on drawings? No. So we have to be guided by Partnership Act 1932 or the deed which is made by the partner. As far as making a partner profit and loss account is concerned, nothing is related to partners, partnership deed or provisions in the Partnership Act 1932. Matching principle, while preparing a profit and loss account, matching principle, that is revenues matched against the expenses, is being followed, and no such principle is being followed in profit and loss appropriation account. Okay, like that some guarantee of profit is given to a partner, so that much of profit has to be provided to the partner. Then appropriation is more than available profit. The most important topic, one of the most important, I cannot say the only most important topic, but one of the most important topics is this: when you have less profits available and more has to be distributed. What more has to be distributed? It could be interest on capital, it could be salary, it could be remuneration. So there are different cases, and very, very good questions are given in T.S. Giraval's book. So you have to see from there the questions. Okay. So first is What is it? Determining the amount of appropriation as per the partnership deed for the each partner. So suppose partnership deed is saying some X percentage of interest and capital has to be given. Let's say that X percentage is coming to be altogether A, B, C, I will write. Suppose A, B and C. A has to be given 5,000 interest on capital, B has to be given 10,000 interest on capital, and C has to be given 15,000 interest on capital. So altogether it is coming to how much? 5 plus 5 is 10, 20, 30. 30,000. And let's say profit available is only 20,000. Now what is to be done? This is IOC, interest on capital, and this is net profit. Okay, net profit is only 20,000. Means the profit is less and appropriation is more. Then in that case, what is to be done? Now we'll have to read the question very carefully. The amount of appropriation we'll have to first verify, is the net profit more than or equal to the total appropriation? Let's say if this profit was 50,000, there was no problem. Okay, 50,000 profit means easily this 30,000 as interest on capital can be given to the partner. So if your answer is yes, over here you can see if your answer is yes, your profit is equal or more than the amount of appropriation, means your profit is either 30,000 or more than 30,000 in my example, then what are you going to do? In that case, you will debit profit and loss appropriation account with individual items of appropriation, distribute bacha hua net profit to the partners in their PSR chain. You know what is their profit sharing ratio. But if your answer is no, means your profit to be appropriated is lesser than the amount of appropriation. Like in this case, I have written 20,000 is the available profit and 30,000 has to be distributed among the partners. Then what you have to do? You will have to distribute net profit among the partners in the ratio of appropriation to be made to each partner. It is when, it is very important, it is when you are going to take this. Suppose this, in this case, in this particular example, when I am saying A's interest on capital is 5,000, B's interest on capital is 10,000, and C's interest on capital is 15,000, and available profit is 20,000. How I am going to distribute 20,000 rupees? I will have to make a ratio of this. Means 5 is to 10 is to 15's ratio I have to make, or I can say 1 is to 2 is to 3's ratio. In this ratio, I will appropriate available profit, which is 20,000 to A, B, and C. If the partnership deed says that interest on capital has to be provided, but do not say that interest on capital is a charge against profit. Listen to me again very, very carefully. Okay, if you want to pause and repeat, you will do that as well. Okay, what I'm saying, if the partnership deed or the question in your case is saying that interest on capital has to be provided to the partners, but the question does not say that interest on capital is a charge against profit, means what? It means what? Interest on capital has to be provided to the partner, but it should not happen that to provide the interest on capital to the partner, firm will have loss in profit and loss account. Firm will not go to suffer the losses to provide the interest if the amount of net profit is insufficient to provide the interest on capital or any remuneration or salary. But the moment question says that interest on capital has to be provided and it is a charge against profit, in that case, this will not be applicable. Okay, what did I say? I will just write it down here because I know some people still will have doubts. So I'm writing it over here. If question says, if you want, you can take a screenshot of it and you can write down, pause it over here and write down. If question says, IOC means interest on capital or salary or commission or remuneration, whatever it is called, is to be provided to partners, and profit is less than the amount of appropriation. So what I did in my case, 5,000, 15,000, no, 10,000 it was, and C's was 15,000. Altogether, it was coming to 30,000. So what I had done, 20,000 profit, I had distributed in the ratio of their interest on capital. Remember this, if their ratio PSR is something else, let's say A, B, C and sharing profit in 5:3:2 ratio or 1:1:1 ratio, that ratio is not applicable. We don't have to do anything with that ratio. We have to take out ratio of this interest on capital or salary or remuneration, whatever it is. So it is 1:2:3. This ratio, in this ratio, you are going to distribute the profit to the distribute interest on capital to the partner, and obviously no profit will be distributed because whole of the profit is exhausted in giving this only. But in case the question has said this thing, oh my god, what this question is saying? Question is saying the partners should be, I'm sticking to IOC now, should be provided IOC, and it is a charge against profit. Charge against profit means the moment question has said that charge against profit means even if the firm has to suffer the loss, full amount of interest on capital has to be provided to the partners. Okay, in that case, what are you going to do? Again, same example, I will say ABC, they have 5,000, 10,000 and 15,000 interest on capital, and profit available is only 20,000. Still you will give them this, and because of this firm will have loss. See, when I make P&L appropriation account, I'm writing very shabbily, but the purpose is just to make you understand. So by net profit, over here you will write 20,000 and you will give full interest on capital to these people. To IOC, A's capital, B's capital, C's capital, full amount you're giving. Okay, and because of this providing them full amount, what has happened? Loss. By A's capital, B's capital, C's capital, you will have to distribute this 10,000 loss, and let's say they are equal partners. So you will have to distribute 3,333 to each one of them. Okay, from 3,333 figure will come. So you will have to distribute loss over here because this line was written. It is a charge against profit. So then we will not have to justify this amount and distribute in this ratio. We'll have to give the full amount. A very good illustration and a good question, same replica of illustration I can say, is given in T.S. Girival's book. Do practice that question without fail. I don't have the book next to me. I can't tell you, but you will easily find that under this heading only, which which is written over here. What is the heading? This is let me go to the other file which I was sharing with you people. This, when appropriations are lesser than net profit available. So you have to do both illustration and the unsolved question from there without fail, because that's very important. All cases 1, 2, 3, 4, 5 cases are given over there. When profit is insufficient, profit is sufficient, profit is equal, all those cases you have to practice from there. Now, the next topic is how capital accounts are made. The previous one was a very, very important topic. Only in revision, I can say that much only what I explained to you all. But yes, you have to do the practice. If time permits, I will come up with some important question regarding the previous topic, which was when the profit is lesser than the appropriation. This is one of the very important topics, and you all must revise as much as possible and practice. Write down and practice the questions. Because this is a video only made for revision purpose, that is why I'm jumping to the next topic. Otherwise, in the normal batches, I spend good amount of time, at least 2 to 3 classes goes only in explaining that particular topic. So you can understand how important it is. Now, the next topic is capital accounts. How capital accounts are maintained by the firm. So they can be broadly 2 ways, not broadly, only 2 ways are there of maintaining the capital accounts by the firm. One is fixed capital method or fixed capital account method, and another one is fluctuating capital method. So when fixed capital method is being followed, what happens? Everything related to the capital account, related to the earnings of the partners, whatever they're getting from the firm, and whatever is getting debited or credited, we can say, to the partners account, everything comes under one account only. Means if there is any balance, opening balance of the capital account will be written over here. If they are further introducing more capital introduction will also come over here. If they are withdrawing capital, not drawings, withdrawing capital, that will also come over here. If they are making drawings, that will also come over here. If there is any interest on drawings, it will also come over here. If there is any interest on capital received by them, this will also come over here. Any salary, remuneration, commission taken by them, that will also come over here. Okay. And obviously share of profit or share of loss, all the things, means everything at one place is coming whenever there is a fluctuating capital method. I explained you fluctuating capital method. Okay. So this one, okay, I explained you just now this one. So what is going to come in a nutshell, if you want to see what is going to come on the credit side of the partner's capital accounts, obviously if there is any further capital introduced, remuneration, interest on capital, share of profit. On the debit side, what is going to come? Capital withdrawn, permanent withdrawal of the capital, it will come. Any drawings against profit, which will come over here, interest on drawings, and share of loss. All this will come. So either share of profit will be present or share of loss will be present. In one question, both will not be present. But if there is a fixed capital method followed, under fixed capital method, there are two set of accounts maintained. One is called capital account and another one is called current account. So capital account has a very limited, things which are coming into this. That is only balance of the capital, any further introduction of capital, or withdrawal of the capital. There is a difference between withdrawal of capital and drawings. Drawings are made against profit, means apart from the share of profit, a partner is withdrawing something extra on which he will have to give interest also. But withdrawing of capital, let's say a partner A was there who had invested 10 lakh rupees in the firm. Now out of that 10 lakh rupees, he is withdrawing 1 lakh rupees. So that is called drawings against capital, and that drawings against capital comes under capital account. So see what is going to come on the credit side. This is further capital introduction or capital withdrawal. That's it. Only these two things are going to come under the capital account. Under current account, what is going to come? Under current account, all other things are going to come. So drawings, interest on drawings, or share of loss, it all will be debited. Whatever is reducing partners capital, current account will come on the debit side, and whatever is increasing partners current account will come on the credit side. That is remuneration, commission, salary, anything, interest on capital, or share of profit. So current account and capital account both are liabilities in the nature. So remember the rule which you had studied in class 11, that any increase in the liability is going to come on the credit side and any decrease in the liability is going to come on the debit side. Means whatever partner has to pay to the firm or partner is charged with like interest on drawing, etc., it will come on the debit side. And whatever partner is receiving from the firm in form of interest on capital, in form of share in profit, in form of salary, remuneration, etc., all that, including rent also, it's going to come on the credit side of partners capital or current account. If this is fluctuating capital, it all will come under capital account. If it is fixed capital account, it is going to come under current account. Now let us move to the next topic. These are two methods to be followed for making the capital account. The question will specify, very important thing, if question does not say anything, if question is silent that which method of maintaining capital account is followed by the firm, then always the rule is we will assume that the firm is following fluctuating capital method. Means in that case we are not going to open current account and capital account separately. Only one account will be opened, that is your capital account. No separate accounting on current account and capital account will be done. It will be assumed that this is fluctuating capital method. But if the question specifies clearly that there is fixed capital account, then two set of accounts need to be maintained. Now, what is the difference between capital and fixed capital and fluctuating capital? I don't think it is very important. That's why I'm just skipping this. And I'm not telling you people to skip. In this revision, which is a short revision from where you can revise everything properly in a fast track manner, I am keeping it to limited it to very important topics and from where the questions are supposed to come. I'm not saying, not denying the fact that questions can come from here, but it is way too simple. You can revise on your own. So I'm leaving it. You revise it from my notes or whatever notes available to you. Now, provision relating to the interest on capital are as follows. What are the provisions relating to the interest on capital? A much of repetition of the same topic where the appropriations were less. So the same thing is repeated over here. I had already explained, but still I will read it from here. First, when the partnership deed is silent as to interest on capital and does not provide interest on capital. When partnership deed is silent, does not say anything about interest on capital, then in that case, interest on capital will not be provided. Why? Because partnership deed has not spoken anything about interest on capital, means the provision of Partnership Act 1932 will be applicable. And the Partnership Act 1932 says that no interest on capital has to be given and no interest on drawing has to be charged. That is why no interest on capital will be provided when partnership deed is completely silent about interest on capital. Case number 2, when the partnership deed provides for interest on capital but is silent as to the treatment, means what I had written there on the whiteboard, that the deed is saying that interest on capital has to be provided, but it does not say whether interest on capital is a charge against profit or no, means whether we have to give to A, B, C, the same example I am picking up, whether we have to give A, B, C into this ratio, into 1:2:3 ratio, or we have to give the entire amount. About that, nothing is being said. Then obviously we will follow this. Okay, means the interest on capital has to be given, but firm ko loss karwa ke nahi dena hai, means it is not a charge against profit. Only the available profits which are insufficient has to be distributed in such a manner that the firm is not suffering loss. Okay, so that example you will refer again. I'm sure you all must have written along with me. If you have not written, pause this video, go back and then see from there. Interest on capital is allowed only if there is profit. Obviously, if nothing is being said and there is loss. Okay, it is only saying, the question is only saying that interest on capital has to be provided. But it does not say that interest on capital is a charge against profit. And the question has given you information in such a way where it says there is loss. If there is loss, like in this example only, if there was a loss of 20,000, I would have not given any interest on capital to anybody, no ratio. Why? Because there is loss. So in the case of loss, no interest on capital will be provided. Okay, first. Then second, in case of profit where interest on capital is equal or more than interest on capital, let's say the profit was 30,000 in this given example only, in this ABC example only. So obviously that 30,000 is sufficient to give IOC. We will give IOC 30,000. IOC will be distributed to all the partners. But if there was profit of 40,000, no problem. Again, it is more than the appropriation. Again, full amount 5, 10, and 15 will be provided to people. Okay. Third case, in the case profit or profit before interest is less than the interest. That case means this case. Profit is, let's say, 20,000 only, what we had done some time back. So here you will have to take out this ratio and then distribute the appropriation. Interest on capital has to be distributed in the interest ratio. Listen to me carefully what I'm saying. Interest ratio, not in the profit sharing ratio. Profit sharing ratio will be something else. Okay. So these cases are very, very important. You have to memorize, practice it. Memorizing is not possible. You have to practice it. Yeah, the concept should be very clear in your head. Then only you will be able to solve these questions. Now, adjusting entries for interest on capital. So interest on capital account is debited to partner's capital account or partner's current account. In case of fluctuating method, will be debited. It will be credited, sorry. Then how do we close this entry? Profit and loss appropriation account is debited and interest on capital. This we had seen earlier only in adjusting entries. Now calculation of opening capital. Now about interest on capital, one very important thing, how do we calculate interest on capital? Interest on capital is always calculated on the opening capital. Suppose this is your beginning of the year and this is end of the year. We do not calculate interest on capital on this amount. We calculate interest on capital always on the opening balance. Now, how question is going to play with you? Question may not give you interest opening capital always. They may give you closing capital amount. So how do we reach? We'll have to do the reverse working. From here, we'll have to reach till here. How do we do that? So First, we'll take this figure, capital at the end. We will normally, whatever things we deduct, we will add because we are doing the reverse working. So interest on drawings, we deduct, we will add that. Drawings itself, we deduct, but here we'll add that because we are doing the reverse working. Then withdrawal of the capital means permanently when you withdraw the capital, normally you minus. General case, you minus, but here because you're doing the reverse working means you are going from down to top. Okay, upside, you're doing the reverse working. So withdrawal of capital also need to be added. And whatever you add in the normal case, that you have to deduct, that is share of profit or any additional capital introduced. In a question, these all things may not be present. Some of these things will be present. So again, this itself is only the understanding. You will not get the clarity until you solve the question. So you have to open your book and real time solve the question. Only me saying theoretically and making you understand will not make any difference if you have not solved the question. So the best thing is that solve it. Okay, if you feel that you need to immediately see after listening to me, you pause it over here and see the questions. Now the last topic for today is interest on drawings. What is interest on drawing? Interest on drawings is a charge, which a firm is going to take from the partners for making the drawings. So the difference between drawings against profit and drawings against capital is an important one, but because it is purely theory, I'm not reading it over here. I had explained you earlier in this video itself. I had spoken a few minutes back about this. So you just go through it from here. I'm very sure you will be able to understand it on your own. Still, if you have doubt, you all tell me. I will explain to you in the next class. There is going to be one more class for the fundamentals revision. There I'll explain to you. Calculation of interest on drawings. How do we do? So what is the method of charging interest on drawing? If drawing is not made uniformly, means suppose a partner A is there, that partner has withdrawn on 1st of January some 2,000 rupees, on 1st of let's say December he has withdrawn 1,000 rupees, sometime back on July he had withdrawn let's say 1,000 rupees again, and on 1st of August he had withdrawn some 8,000 rupees. Now then 15th of March he had withdrawn some 7,000 rupees, like this. Means uniform dates are not there. Sometimes he's withdrawing on 15, sometime on 1st. And amounts are also not uniform. So here what do? We have two methods, product method and average method. So product method is applicable over here when the amount of drawings is not uniform and even the date is not uniform. In that case, total of product means we will multiply the drawing amount with the number of months and rate of interest divided by 100 into 1 by 12. Okay. What is total of product? I'll write over here. Total of product is the drawing made by the partner and number of months left for the year to over. So let's say he has withdrawn 2,000 rupees on 1st of April. So what are the number of months left to be over? 12 months. Let's say he has withdrawn on 15th of March 10,000 rupees. So 15th of March means only half the month is left for the year to get over. So we will multiply these two things and take out the product. Product means this. So all this multiplication, and here we will find out total of product. So this total of product is being referred over here. Total of product multiplied by rate of interest. Rate of interest will be provided to you in the question. Divide by 100 into 1 by 12 or 1 by 365. Normally in number of days it does not come. It comes in the whole number itself. Okay. So this is very, very simple. But next one, when average period method is to be followed, average period method, you have to, see what is the average period. In where do we apply this average period method? Average period method is applicable when the amount of drawings is uniform and the date is also uniform. Let's say one partner A withdraws every month. Okay, first of the month. Let's say on 1st of April he withdrew, on 1st of May he withdrew, on 1st of June he withdrew, then July, then August, and so on. And the amount is also uniform. Let's say he is withdrawing each month on the first date of the month 5,000, 5,000, 5,000 and 5,000. In that case, what is going to happen? This average method is going to be applicable. This date can be changed. This amount can be changed. each partner, but each month and each date, it should be same only. Same amount and same date should be there. He may withdraw the same amount on 15th. He may withdraw the same amount on 30th. Okay, that information will be provided to you in the question. So what is the formula for that? The formula is month left after the first drawing plus month left after the last drawing divided by 2. Like this, you find out the average period. Remember this is not the formula of finding the interest on drawing. This is the formula of finding out the average period. See what is written over here. This is the formula of finding the average period. So let's say one partner has withdrawn 2,000 rupees each month on first. So this is going to be 2,000, okay, multiplied by 12. This is the total amount of drawings, 24,000. And average period, how you are going to withdraw, or how you are going to find. So months left after first drawing. So first drawing was done on 1st of April. So 12 months are left. Last drawing was done on 1st of March. So 1 month is left. Divide by 2. So 12 plus 1 divided by 2. It is going to be 6.5. And this is how this average period is being calculated. So applying this formula, you can take out interest on drawing for various periods. So if it is end of the month, it is going to be 5.5. If it is middle of the month, it is going to be 6. Okay. Now drawings can be done quarterly also. If drawings are quarterly, average period is going to be 7.5, 4.5, 6. I think this particular topic I will take in more detail because this much of saying is not enough and it is already exceeding the time I had promised you people. So I will be taking this particular in the next video. Interest on drawing and the remaining topics I will take in the next video. Again, we'll try to do one hour class. I will inform you priorly and then we'll revise everything. So today, whatever we have learned, you all will revise it properly and must do is questions related to it. So do it. So all of you do revise well and make the best use of this video. And we'll be meeting very soon with the part 2 of revision of fundamentals. Till then, bye. Have a nice day.